The Financial Huddle does not provide tax, legal, financial, or other professional advice. Listeners are encouraged to consult with their own advisors in these areas.
All right, everybody, huddle up. Play calls in. This is the Financial Huddle. Ready? Break.
Welcome back to the Financial Huddle, everybody. Thank you, huddlers, for taking time out of your busy day to be with us. I am Brian Manier, and I am here with my partners and compadres, Ed B. Miller.
Hello, hello.
Ryan Fleming.
Hello, Brian and Ed, and hello to everybody out there. Thanks for joining us.
Thank you. And how are you both doing today?
As I said, every day's a good day. Every day you wake up and put the shoes on and come into work, and
every day above ground is a good day.
It's a good day.
That's right.
I'm a little sore.
A little sore?
Been trying to get back in the weight room a little bit. Yeah.
Really? You can't tell. I'm sorry.
Oh no.
Oh, he's going that. I'm hurt. I'm trying to fight off Father Time.
I got you.
You know, so I'm
I
trying.
always say he's going to win, but I'm going down swinging.
Yeah.
There you go.
Yeah.
That's right. But the chicken wing is a little bit bruised up, huh?
Yeah.
A little bit injured.
Well, Ed's motivated me here. I'm gonna do a couple more reps.
You look good.
He may sit down and do 20 push-ups right now if we
That's another podcast. We might have to do that. Who can
Push-ups.
Who can do the most push-ups?
Make sure you're working out there, huddlers.
That's right. Well, I'm so glad you guys are here. And as we reflect on why we do not only this podcast, but why we do what we do, it's really to put people in a better situation than when they started. So when you think about it, that's why we do. We want to try to help people, make them better, put them in a better situation than when they first met us.
Be better, be good stewards of money and their health, their mental health.
And one of the things that we do as a firm is we wealth manage because we want to try to help grow their money. We try to help them grow so that they have more than when they started. And that is the whole principle of investing.
Mm-hmm. Sure.
Now, there's a lot of things that you can look at and you can take different positions. And when I think about investing, is it a little bit like gambling? Because there is some unpredictability, there's some uncertainty
the casino
of how market works. And I was thinking about that, and I was thinking about a time I was actually at a casino, and I was with a really good friend that you may or may not know this person. And we were at a casino, and this person liked to play 3-card poker. Now, I like to play a little bit of blackjack.
It's a great game.
It is, but I'm not one of these people that always says I win every single time. I probably have lost more than I have won, but I do enjoy playing, especially blackjack. I like to play roulette a little bit, but I like to play blackjack. Well, this person was like, I have to play 3-card poker. And I told this person, do not play 3-card poker because you're going to get raked. And the person looked at me and said, no. I got this. I win every time.
He's Rain Man, right?
He knows what they're doing. I got it. I'm like, all right. So I went to the blackjack table. This person played 3-card poker, came back, checked on this person, and this person may or may not had a look on his or her face of, I'm in trouble.
Oh, boy.
So I said, how did you do? And this person said, I'm down $750. And I need to go make a trip to the ATM because I need to try to recover. And then, as they were walking to the ATM, person said, please do not tell my wife.
Oh, no.
This is between you and I. So
wait, he was down $7.50?
Yeah, $7.50. Right?
Yeah.
Oh, boy.
Move that decimal.
$750,000.
Hopefully not that much. Hopefully not
$750,
Yeah.
right? Yeah, that's what we're saying.
So
that boy was caught up in the vortex.
A little bit.
Oh, man.
So even when we think about, hey, I know what I'm doing from a gambling perspective, it doesn't always work out that way. So anyways, what we thought we would do today is talk a little bit about investing, because that can mean a lot of different things to a lot of different people. But what we thought we would do is just simplify it. We want to, if you're a basic investor or you're young and you're trying to start a retirement account, what does that look like? What are some of the basics of investing?
So what did we title this episode?
Basic investing for dummies?
There we go.
Don't take it personal.
Listen, we've all read those home improvement books, the Home Improvement for Dummies.
I may have a couple books that say blank for dummies on my bookshelf somewhere.
It's really just meant to be dummies equals an introduction to this topic. That's all it is.
That's right.
We're not doubting your intelligence.
That's right, because a lot of people, just like anything, you may want to start something, but you don't get into it because you're overwhelmed and you're not sure what to do with it.
Or fear.
And the reality of it is the market is a great wealth tool. Take advantage of it. Use it properly.
We talked about that in our last episode, I believe.
Think we have.
Greatest wealth generating tool, maybe
available.
Maybe in the history of mankind.
Yeah,
that's right.
Arguably.
And so what we would say is don't be afraid of it. And I think I said in our last episode, sometimes boring is better. So let's talk a little bit about investing. And I think, Ed, we got to start out with stat time.
Oh,
it's that time.
It's that time.
It's stat time.
So we're going to focus kind of our stats here on investor behavior, because ultimately that's kind of what controls. And just like that gambler, his behavior basically made him go to the ATM, take more money out, and probably lose more money, right? So
Possible.
we could call that bad investor
may or may not have
behavior.
You're only one hand away of getting it back.
There you go.
That is true.
So there
that.
is a report that is published each year. It is called the Dalbar report. And this is something that if you're in the industry is kind of like the Bible, where, the facts and figures, and it really kind of tells you where things are in the financial marketplace, the behavior of investors, this types of things. So, a lot of people look forward to
the report,
to reading that report and going through it. So this is, obviously we're in 2026, but 2025 won't be released for a while. So I'm going to go back to 2024. And this is the first stat is the average equity fund investor earned 16.54% in 2024, while if you would have invested in the S&P 500 fund, you would have earned 25.02%. So an 8.48% difference.
It's a little bit of a gap.
That's a gap, and that gap is a result of timing. It's a result of selling or buying, and as opposed to kind of more holding. It's allowing those emotions to get involved, and
it's a pretty big difference,
making you make potentially poor decisions. But this doesn't just mean one person did this. This analysis goes across the board and looks at
all those investors. Yeah,
correct. And you may find it surprising or not, but this has actually happened in the same report. 15 consecutive years
that the average equity investor has underperformed just the S&P
index. And the last time the average equity investor actually achieved a higher rate of return was 2009.
Well, right after the housing market crash.
Yeah.
Well, you'll never necessarily keep up with the index because you might have like a fee or so, but that egregious of a difference alludes to a bigger issue going on.
That's more, I like to say that's more than fees.
Yeah.
We're not just talking fees there. And then kind of in the same, statistical behavioral analysis with investors and things, and a lot of us have probably heard about this, but when you actually put some numbers to it, there was another report that came out. And based upon a $1,000 investment in the stocks that make up the S&P 500. So, and this goes back, it's a little bit dated, but if you put $1,000 in, and it's a 1 decade period from 1970 to 1980, if you basically just let it sit, and it was a buy and hold strategy,
kind of cook in the oven.
Yeah, that 1,000 would have been worth $121,353. Now, here's the problem. Most individual investors, as Dalbar has repeatedly shown through data and factual evidence, don't do that. They think they know, all right, I can time the market or I can do this. So they, rather than set it and forget it per se, they make changes. They buy, they sell, they do different things with that. And the cost of emotional investing. So what if that same investor, instead of, they basically, instead of just the buy and hold with that $1,000, letting it cook or letting it bake for that 10-year period, what happened if they missed, during that period of time, the single highest return date
of the market,
once again, of the highest 1 day return over that decade? their account value would have gone from $121,353 down to $108,758.
Just by trying to move it around.
Just one day. Yeah. They got out of it one day. Well, the numbers get worse. The next thing we look at, well, what if they would have missed the 5 largest return days, over that decade? That $121,353 goes down to $77,056. So think of that, 5 days. Do you think over a period of 10 years, how many days are in a year? 365?
Last time I checked.
Yeah. 10 years.
Leap year.
Yeah.
10 years.
That's crazy.
Simple math.
Yeah.
5 days you missed.
Yeah.
And a lot of times people will pull out of the market. Oftentimes it's after a lot of volatility, or they think volatility is coming up, or after a correction. Well, that's the worst time. And we've talked about that.
Or I may add, sometimes they pull out of the market when they don't really want to because they don't have an emergency fund.
Right.
And something happens.
They may have to sell.
And they have to sell because they don't have any other liquidity.
Right. They don't have any of those buffer assets.
We got to get that emergency fund.
Yep.
6 months.
The last stat on that, if you missed the highest 15 days in that decade, your account value would be $43,472 as opposed to $121,000. So just approximate math, 34%.
That's crazy.
Of the value you could have achieved if you just would have set it and forgot about it for 10 years. So just when you see those numbers, and this is factual data, I mean, it's not like my opinion or anything with it. It really brings home that idea of you really have to
have time in the market.
Time in the market and watch. Don't let the emotions control the decisions you're making.
That is so hard for some people.
Oh, it is. Yeah. It is. And, often, a lot of people nowadays do everything themselves, right? I mean, we're DIY and a lot of people, I'll talk to clients that, I kind of day trade on the side and like, all right, do you work full time? Oh, yeah. But then I'm up 35% every year. Oh, okay.
Yeah.
So,
well,
the validity of that is
everybody's suspect. Always up. But when you read that Dalbar report, we're saying that not everybody's up.
Oh, yeah. Yeah.
Going to the casino it's emotional. It's exciting.
It is exciting.
Yeah, there's the risk and reward with that. And, given the fact that there's so many trillions of dollars that are floating around in the market or in these investment vehicles or, whatever it is, I thought we would just, in typical fashion here with Investing for Dummies, is just talk about just high level different types of investment strategies that people can be thinking about. Of course, inside these strategies, you have things like stocks, bonds, mutual funds, ETFs, cash, CDs, money markets, real estate. Like those things are opportunities to invest and get a return. But there's a couple strategies that people have access to that they may or may not know about. One is called an active strategy, right? An active strategy is it's kind of like timing the market, kind of antithetical to what we talked about here. It's very difficult to do. Even the professionals that profess to be active managers don't do a great job with that because you have to be perfect. You have to get out at the right time and get right back in at the right time. And you could hit a home run if you did that, but it's very hard to replicate. And the reality is that's probably one of the most expensive ways to invest, right?
Yeah, a lot of fees.
There's a lot of fees for an active management, but there could be a place for that for somebody out there. But active management is that at a high level. So you may choose to do a little bit of active management or hire somebody that professes to be good at that.
And logically, people will say, well, why don't I just get out now when I think the market is going down, and then I'll just get right back in.
Yeah, well, like Ed just illuminated that.
How do you know
how
when
good
it's
are people
go
timing
up?
the market?
Right.
Yeah.
It sounds very easy, but
in
reality,
principle,
it's very difficult.
So that's one way,
very
active
difficult.
management. That's out there, or maybe like a hybrid of that or something. But another one is just a straight up indexed approach, right? Warren Buffett's been on record saying that if you are an investor dummy, all right, and you don't really know a lot, you might be better off just putting your money into an S&P 500 index or a Russell's index, or just pick an index and let it cook in the oven. Let's let it marinate, and that you would do better than the average investor, average fund manager that's out there. And that kind of goes along with the Dalbar
Well, the
report,
Dalbar basically stated that factually.
kind of confirms and
Yeah,
affirms
confirms
that,
that.
which
Yeah.
that's very interesting.
Right.
So you got the indexing approach, but the problem with the indexing approach, somebody could argue, is that it just lacks diversity, right? So if you're in the S&P 500, those are the 500 strongest domiciled U.S. stocks, but you lack international funds or you lack emerging markets. So, if you want a little bit more diversity, you might want to look at a different way. Okay. The other one is just exactly what we said, passive, right? So you have active, you have indexing, and you have passive. It's literally just buy and hold, right? And you could throw in a lot of other types of strategies. Those are three just kind of generalities. One, there's another type of strategies called an evidence-based, and we don't have to get into that today, but it's just a certain way certain funds are tilted, maybe to tilt their funds a certain way relative to a benchmark. So maybe they might carry a little bit more small cap versus the benchmark, or
And they
just
overly
the holdings.
diversify them.
yeah, it's a different approach. But if you want to learn more about that or any of these strategies, we just invite anybody to come in, set up a meeting with us. But it's just important to know that there's different types of ways to invest and to strategize to try to grow your money. Okay, and so in that, one of the more important ones that are out there. As far as investing, I pulled these up for you guys, is I just wanted to give a quick side-by-side comparison to some popular things out there called mutual funds versus ETFs. These are kind of big in our culture right now. And, a mutual fund versus an ETF, many people have these within their retirement accounts, their brokerage accounts, so on and so forth. But to give you an example, inside the strategies, mutual funds are bought and sold directly with the fund company. ETFs are traded on stock exchanges like a stock. The ETF pricing changes throughout the day, whereas the mutual fund pricing is just priced one time per day after the market close. Right, so there's some nuances there. Expense ratios are typically lower in ETFs versus mutual funds. And I could go on, but these are just little nuances inside the strategies that people need to understand about investing. Another thing that people need to understand about investing is how fees work. And I also pulled up an exhaustive list over here about fees. And we certainly don't have time to go over all these fees, but there's a lot of fees out there, guys, in different ways. So you might have an advisor fee or a management fee is what we call it. An advisor might charge 1% to help manage your portfolio. There might be a retainer fee. There might be an hourly fee that an advisor might charge you. But moreover, inside certain funds, like a mutual fund, every fund out there has an expense ratio, and every fund has a different price per how expensive that expense ratio is. You may have a fee because there's a compliance arm through like a registered investment advisor like we work through, and they may charge a fee to monitor all the emails, all the presentations to make sure the advisor's on the up and up.
All the compliance.
A lot of compliance. So my point about that is whether it's a retirement account fee like a 401 fee, like a 12B1 fee, an advisor fee, you have to understand as the investor, what is my all-in cost for this strategy?
Yeah. And a lot of those fees are what we call hidden, right? And what I mean by hidden, there's compliance where they have to basically provide that information upon request. But if you look at statements and things, there's a little small print where, we got to get our reading glasses on nowadays to actually see that. It's not the easiest thing to determine.
Well, a lot of people say,
what the fees are.
I'm only getting charged 1%. But when you take a deeper look, it's the 1% from the advisor, it's the 0.5 basis points on your expense ratios, and you've got another fee over here. And next thing you know, you're all in at 2.
Right.
You're all in at 2.
Right.
Most
people do not have a clear definition of what their fees are.
So if you're going to be an investor
in the different accounts,
if you're going to be an investor, you need to make sure you ask, what is the all-in fee that I'm going to be paying? And if an advisor can't lay that out clearly and transparently, then you might want to walk away.
Yep.
Right?
Yep.
So when you're thinking about investing and you're trying to get into how do I invest in a certain type of account, all the things that we've talked about before when you look at taxes, but when you just look at the breakdown of what kind of strategy, what kind of fees, and what is my time horizon, when you break it down into those three things, it will help you determine what type of an approach to take.
What are the best options to consider.
Yep. So look at those three things.
Yeah.
So with that, we want to thank you guys for taking time. We always enjoy being here to serve you. Make sure that you subscribe to our pages, make sure you follow.
Yeah.
And also make sure you tell people that we're here to help as well. Don't be afraid to
That's
share.
right.
And make sure you're listening to all our podcasts because they're all great, right?
All amazing.
They're all amazing. Don't just listen to one or
Yep.
two. Get them all in there. Keep
Yep.
up to date with us.
That's
Appreciate
right.
you, huddlers.
Yeah, huddlers, have a great day. We'll see you next time.
Thank you.
Take
Till
care.
next time. All right. Bye, guys.